all seeing the headlines, the next Amazon, the next Apple, or the next Nvidia. You see the charts pouring through your social media feeds. If you had invested $1,000 at this date, it would be turning into this many millions. And people stare at those charts and they start doing the math in their minds. Okay, well, I had $1,000 back then. What if I just bought a little bit earlier? And maybe that's why IPOs attract so much attention. Every few months, a bunch of companies go public and suddenly that's all anyone can talk about. And you can't help but see it everywhere. The excitement starts to build, the bell rings, and millions of dollars begin flowing into a company that most investors never knew even existed until a few weeks earlier, which I find fascinating because it was there yesterday and the products were there yesterday and even the customers that bought those products were there yesterday. Yet the moment it becomes publicly traded, something fundamentally shifts. Not inside the company so much, but inside mass psychology. A business that barely registered on our radar a few months ago suddenly becomes this huge hot opportunity, which naturally raises the question, what exactly are you buying when you look to go purchase into an IPO? Are you buying the business, or are you buying the story behind the business? Is it the possibility of future returns? Or perhaps it's some combination of all three. So to answer that, it helps to understand what an IPO actually is. IPO stands for Initial Public Offering. At its core, an IPO is simply the moment a private company becomes available to public investors like you. So before that happens, ownership is usually concentrated among founders, employees, some venture capital firms, private equity investors, and some other early backers. These are people who got involved long before you would ever have access. One day, the company decides to open its ownership to everyone else. That's the IPO. A company creates and sells shares, you buy them, everyone moves on. But beneath the surface, much more is actually happening here. The moment a company goes public, mass expectation now becomes part of the equation. Public's opinion is a very powerful thing. Just think no further than GameStop phenomenon of 2020 and 2021 as a perfect example. Most people assume that companies go public because that's when they've become successful. There's definitely a role that success plays in helping them go public, but the primary reason is creating capital. Growth within the business requires capital, whether that's hiring employees, building products, expanding into new markets, or even paying down debt. So going public gives a company access to a much larger pool of money that it couldn't access privately. There's another side to this as well. Early investors eventually want liquidity. Founders who spent 10 or 15 years building a business may want some financial reward for all the risk that they've taken. Or you have employees who have accepted stock options as compensation, and eventually they want to convert the value in those shares into something that they can actually spend. A company is raising money, early investors are gaining liquidity, and new investors are being invited to participate, a simple transaction. Which now raises the question, if that's all an IPO really is, why does it generate so much excitement? As humans, we love a good story. We always have. Long before markets ever existed, stories were how we shared information about the world. And an IPO almost always arrives wrapped inside a compelling story. Maybe it's that the founder is a visionary, or the company is disrupting an entire industry, or that growth is explosive and the future looks bright. Or maybe it's a story of scarcity about the opportunity won't last forever. You can probably hear the stories practically telling itself by this point. And in some cases, stories are powerful because they allow us to imagine a future that doesn't yet exist. So if you think about it, when someone buys shares in a mature utility company, the stories they're telling about their future are likely a lot different than someone who's looking to buy shares in a newly publicly traded tech company. This is where things can start to become skewed. One of the most important lessons in investing is that a great company is not automatically a great investment and vice versa. Most people hear those words and assume that they're pretty much the same thing, but they're not even close. Imagine for a second that someone offered you a beautiful waterfront home for $1 million. You'd probably look at that and say, yeah, I'm pretty interested in it. Now imagine they ask you to pay $10 million for it. Suddenly, that's a very different proposition. Nothing about the underlying asset has changed except for the price. Or more accurately, the price you think you'll be able to sell it for in the future. That's really what we're talking about here. Most people who buy a business right after an IPO usually did so because they expect they'll be able to sell it for more in the future. At this stage, there usually isn't a strong cash flow component to the business, so they're probably primarily looking at pure growth. By the time an IPO reaches public markets, many institutional investors have already gone through and studied the company for months. Teams at investment banks have reviewed the financial statements, analysts have evaluated various different risk factors, and fund managers have already met with all the executives. Meanwhile, retail investors are making decisions based on the headlines, a podcast that just came out, a social media post that they saw, or a YouTube video just like this one. Simply means that the information gap might be larger than most people realize. And this is worth remembering when those feelings of excitement or fear of missing out start arising. The next thing to know is the IPO price is ultimately an estimate. It's a proactive attempt to balance expected supply and expected demand. Once public trading begins, supply and demand will take over, and the markets do what markets always do. They attempt to anticipate. The market isn't voting on whether the company is good or not, it's voting on what they think they'll be able to sell it for tomorrow. At Sparrow, this is one of the reasons we teach our clients about the difference between investing and speculation. We teach the core and explore principle. Getting lucky with an IPO or speculating is not a sustainable long-term strategy. And this, of course, is assuming that you're in fact thinking long-term. Unless you're a business owner and you have the ability to fundamentally create an impact in your specific business, most wealth is built through consistency of positive habits across time, such as regularly converting your fiat currency into hard asset, or diversifying broadly, keeping your costs extremely low, reducing your taxes wherever possible, clarifying your values and your intent, and understanding how habits play a role in your behavior. That's not very exciting, and it probably won't be triggering that same fear and greed part of your brain that the media algorithms have evolved to target so accurately. But when we look at investing, or the core part of core and explore, investing and excitement have never really been close friends. The more exciting something feels, the more cautious I tend to become. Excitement has this very tricky way of convincing us that discipline is no longer necessary, and that's usually when mistakes start to happen. We do have the exploratory part, and that can play a key component of your overall strategy, which allows us to safely scratch that itch. And if you really feel like it's important to participate in private markets or these speculative IPOs on day one, that allows us to do so in a controlled and safe environment. So if someone's considering an IPO, what questions should they ask? I like to start with 4 key questions. The first question, do I know the business? Not the product or not the app that you're using daily, but the actual business. How does it make money? Who are its competitors? What advantages does it have, and what could go wrong in the business? The second question is whether or not you understand how it's valued. Like we mentioned earlier, a great company can be overpriced, and it's all about what we think we can sell it for tomorrow. The third question is one of my favorites, one of the most telling questions, is imagine this IPO that we wanted to buy, it drops 30% next week. Would you still want to own it? Because that question reveals your motivations. If you answer no, you might not be investing, you might be speculating. The fourth question is a little bit more practical, where we imagine, okay, let's say it goes up 30%. What happens from a tax perspective? Is it being held inside a tax sheltered account? Will there be gains that are taxable? Sometimes investors spend enormous amounts of energy trying to maximize returns while completely overlooking taxes. And of course, we know taxes matter because what you keep is ultimately more important than what you earn. So when people ask whether IPOs are good or bad investments, I think they're asking the wrong question. Instead, we should ask, what story am I telling myself about this opportunity? Is this part of my investing work, or is this speculation? Is it my core, or is this explore? IPOs themselves, there's nothing magical about them. They're just another data set in the big picture of your financial life. So unless you're deeply involved in a very specific business and you can influence its outcomes directly, over the long run, the quality of your decision making tends to matter more than the outcome of one individual investment. And your ability to make good decisions are directly linked to having clear values and intent. That will enable you to enjoy reading those headlines without being influenced by them over the short term. So if you're currently thinking about investing in an upcoming IPO, you'll probably be interested in this video here, where I work through the impact of unintended consequences of your investing decisions and how you should think about it. I'll see you over there.